Anyway, let's get started with the program today. Last week, I talked to you. I opened up the program. We spent a half hour on a tutorial on bonds. You know, what's the difference between stocks and bonds? And I went through it. And I'm doing this for a reason. I have a lot of young listeners on the program now, and I'm surprised at how many email me, I run into places. There's this one young man who I run into at the Tom's River Stop and Shop. He works there. And that's where I do my banking and so forth. So when I go in there, the first time he ran up to me, "You're Lou Scatigna," and I'm like, whoa, you know. And he made a big deal out of listening to me every week. I felt like a celebrity. So every time I see him there, we talk for a while, and he's a smart kid, and he loves listening to the show. But he doesn't know, he doesn't have stocks, he doesn't have bonds, he doesn't have everything. And there's a lot of people I think like him out there that do listen to the program, and you know, we try to teach them. Now, for some people, this may be rudimentary, and you may have experience in this. So I may be a little boring for you. If you're on a podcast, you can zip ahead if you want. But this week, I want to talk about stock. What is stock? What is the stock market? How it works? Different types of stock. How do you invest in the stock market? Now, one thing we're seeing over the last year or two is small retail investors are opening millions and millions of accounts and starting to get involved in the stock market. Which is good on one hand because younger people are starting to learn how to invest, but on the other hand, they're really learning how to speculate. They're not looking to invest, and I'll talk about the difference between investing and speculating in the segment. But at least they know that there's places they can go to get a better return than a savings account at the bank. So they're learning the ins and outs of the market, but many of them are opening up accounts because they're on Reddit and they're talking about how GameStop went from $5 to $260 or $300, and they want to be part of that. And they're opening accounts. There's a new, relatively new brokerage firm called Robinhood that is really catering to the small accounts. There's no commissions to buy or sell. There's a lot of groupthink there. Many of these people got stimulus payments, so they took their stimulus payments and are investing it. They're gambling, really, with it because they are short-term speculating, and many of them got hurt. Some are speculating in cryptocurrencies and so forth. But let's talk about what is a stock. A stock is also known as equity. All right, a stock represents ownership of a fraction of a corporation. So here's an example. Let's be very simple. Suppose there's 1,000 shares outstanding, and you own 100 shares. Well, you own 10% of that company. You own 10% of the outstanding shares of the company. Now, if you take that and you take it with 100 million shares, like I don't even know how many shares are out in Apple these days, but take 100 million shares, which many big public companies have hundreds of million shares outstanding. I mean, you have 100 shares, you have a fraction of a fraction of a fraction of 1% of the company. But nonetheless, you own part of the company. As I said last week with bonds, you're loaning money to a company. Stock, you're owning part of the company. Now, stocks change hands on stock exchanges, and I'll explain what stock exchanges are and how they function. But the beginning of a stock, how does a stock become a stock? How does it become a publicly traded vehicle? Well, they go public. It's called an initial public offering. So a small private company or even a medium-sized private company all of a sudden wants to raise capital. The only reason you want to be a public company is because of access to capital markets. You want to raise money because you want to expand your business or you want to acquire other businesses. So you go to an underwriter, which is usually a big Wall Street firm, like JP Morgan, Goldman Sachs, Morgan Stanley, and they will take your company public. They will sell shares of your company, however much you want to make available. Is it 50% of the outstanding shares or 30 or 80%? And you have them raise the capital for you for a fee, of course. And then the company goes public and it starts trading on the exchange. And now other investors who didn't get involved in the initial public offering can buy stock, and people who got involved in the initial public offering are able to sell stock. Now, a lot of times, these stocks open up for trading very high compared to where the initial public offering price was. Example, like Facebook or Twitter or any of these where investors really want to get it, but they couldn't participate in initial public offering. And that's the thing about these initial public offerings, especially ones that are really desired. Only the brokerage firm's best clients get it. And that's a real problem because there is discrimination against the retail investor. If you're not a multi-million-dollar client of a Merrill Lynch or a Goldman Sachs, you're not seeing a share of this stuff because they're called hot shares, they're called hot IPOs, meaning these investors know that they may make 100 or 200% on their money the first day it trades. And many of them just dump it. The first day it trades, they dump it, they make an easy, guaranteed 100%, 200% on their money, and they wait for the next initial public offering. And who are they selling it to? They're selling it to the retail investors who say, wait a second, I want in on Facebook. And they're willing to pay twice as much or 3 times as much as the initial investors made. Which again, that's a problem with that. So people buy stocks for 2 reasons. They buy stocks because they think the company is going to do well, and they want to be part ownership of that company. The value of the shares will go up as the company's earnings go up, as the company business expands. And sooner or later, when the company makes a lot of money, they're going to start paying dividends to the shareholders. They don't have to. Some companies decide to take their profits and reinvest it in the company. Why would they do that? So they don't have to go to capital markets in a secondary offering. Once a company's public, they can raise more money by issuing more shares. But many companies don't want to do that. Why wouldn't they want to do it? Because it dilutes the existing shareholders. If there's, for very simplicity, if there's 1,000 shares outstanding, and I own 100 shares of that, I own 10% of the company. If they issue another 1,000 shares, I only own 5% of the company. So I'm being diluted. And existing shareholders don't like dilution. Unless that money going into the company is so important that it's going to grow the company enough to make my shares worth more than they are today. So you could avoid doing that by taking your profits and reinvesting it in the company as opposed to paying it to shareholders, only to have to go to the market later on and issue more shares. So companies sell stock so they can grow their business, and then they may offer more later on. But they also may buy back shares at some time. You've heard this lately. The last few years, 5 years or so, maybe even longer, companies have been buying back their own shares, the opposite of issuing shares. They're using their earnings, or in many cases, borrowed money from the corporate bond market that we talked about last year. A lot of companies are going out there, borrow money at relatively low rates of interest from the bond market, taking that money and buying back their own stock, taking stock out of circulation. And that's the opposite of dilution. It's concentration. So if I had 10,000 shares, if I had 100 shares out of 2,000 shares, I had 5%, and they buy back 1,000 shares, now I own 10% of the outstanding shares. So the value of stock tends to go up when a company's buying it back, and that's the reason why you hear about all these buybacks. Because that's one artificial way to make your stock go up. You don't have to expand earnings for your stock to go up. You just take stock out of circulation with borrowed money. Now, long term, that could be very, very detrimental to the company because they're taking on debt to buy back their own stock. But shareholders don't necessarily own the corporation. They own the shares of the corporation, but the corporation is its own separate entity. Like a shareholder can't walk in into an office of a company and walk out with a chair because the corporation owns the chair, not the shareholder. It's a very simplistic thought, but I'm just saying is that you can't do that. You can't say, wait a second here, I own 1,000 shares, you're a company, and I want this office chair. Owning stock gives you the right to vote in shareholder meetings. Many shareholders never take advantage of that because they don't think that their vote means anything, and they're right. Only the large blocks of stocks that are held by pensions, mutual funds, hedge funds really make a difference in voting. So your 100 shares isn't going to make a difference. But you have a right to, and if you're a large shareholder, you could influence the board of directors. And it's the board of directors of public companies that run them. They choose the CEO. They choose the CFO. They choose the direction of the company. They decide whether or not they want to acquire a new plant or building or another company. They decide if they're going to pay a dividend and how much. Now, board of directors of companies are usually voted in, and they're always voted in, and they're usually large shareholders. So if a big hedge fund owns a lot of stock, they're going to want their man to be in the board of directors because he's going to influence the company for them. So they'll nominate somebody affiliated with them to be the chairman of the board or just a regular board member. Board members get paid to do that, either through stock options or stock. And it's a very prestigious thing to be on the board of a company, especially a very prestigious company. You'll see a lot of times when politicians retire, they'll show up on the board of Johnson & Johnson. How about this? A past health official for the U.S. government, I'm not going to mention his name, he retired, and now he showed up on, actually, it's a former head of the FDA. He retired, or was replaced, and now he's on the board of directors of Pfizer. How nice is that? He just was in a position of power to affect Pfizer's profit through vaccine and all that stuff, and now he's rewarded. And that's what it is. This is the swamp, my friends. This is how the swamp works. Same is true in banking. If you're on the Senate Banking Committee, you're being influenced by these big banks to do what they want you to do for them. And then when you retire, all of a sudden you're given a cushy board job with a lot of money. That's the payoff. That's the quid pro quo. And it's not illegal. But that's the way the game is played. That's how the club operates. But back to stock. The board hires a chief executive officer, a CEO, somebody in the industry who's really good. Sometimes you hire them away from another existing company with a better compensation package. Or sometimes the CEO sees great growth in that company and he thinks he can grow it, so his stock options will be worth millions. It's a little different when you're on a board, the CEO of Johnson & Johnson than the CEO of Tesla. Because Johnson & Johnson stock doesn't really appreciate the way a Tesla would. 1,000%, return. And established companies like Procter & Gamble and Johnson & Johnson, they're very steady growth. But not spectacular growth like smaller companies can do. So the management of the company is through the board of directors and the chosen management team to run the company. So why stocks over bonds? Well, historically, stocks have a better rate of return over time. Especially now with bonds yielding so less. But the negative is you could have either a bear market in a particular company. You could have a bull market in the stock market, but your stock could be going down because the company's having problems. Not all companies are successful just because you're in a bull market. There's bankruptcies. There's declining earnings and profits and competition. There's inflation of supply costs. There's wage inflation that could hurt a company. There's international competition. There's trade practices that can hurt you. There's tax policy that can hurt you. So you can lose money in the stock market. Many people do. I've had many experiences losing money in the stock market. And some total losses. So that's the reason why everybody doesn't put the money in the market. And that's why, older people, conservative people, wouldn't touch the stock market because they're afraid, they're going to get caught in a bear market, a crash, or if they buy an individual stock. So what type of stocks are there? Well, the first one is the blue chip stock. You heard the term blue chip. I should look up where the term came from. I like to know that stuff, but I never have. I'm sure there's an explanation. But blue chip stocks are the really large companies. They're in the Dow. They're in the S&P 500. They're also called mega cap. Capitalization means how many shares are outstanding and what's the price per share. So if you have 100 million shares outstanding, and the stock is trading at $10 a share, well, 100 times 10 is a billion. So you have $1 billion market cap. Now, $1 billion market cap would sound like a lot. It's not. It's not a big cap stock at $1 billion. That's a small boy. We're talking about, how about Apple, over $1 trillion market cap? That's a blue chip. Now, blue chip stocks often pay dividends. You take a Microsoft, you take an Exxon Mobil. These pay dividends. These are your big caps, the S&P 500. The 500 biggest companies in the country tend to be in the S&P 500. So if you buy an S&P 500 mutual fund, you are investing in the 500 blue chip stocks that make up the S&P 500. Now, by buying a fund like that, and that's I'm going to go over one of the ways you buy funds, is that you buy the whole market. You're not buying one company. Because when you buy stock in one company, you're taking specific company risk. You're not investing in the stock market per se. You're investing in one specific company, in one specific industry. So all your eggs are in one basket with one company. And that's very dangerous. It could pay off spectacularly if you're in the right company. If you bought Tesla when it first came public, you did extremely well. If you bought Apple when it was $15 a share, which I remember 20 years ago, I didn't buy it. I wish I did. And you hold it long term, and we'll talk about investors versus speculators in a second, you did extremely well. But that's specific company risk. What if you had all your money in Ford and we had 2008 and Ford went bankrupt? Or AIG or any of these other companies that stocks plunged? Or companies that just totally disappear? And that happens all the time. And that's why a lot of people look for mutual funds or have enough money to buy a lot of stocks in a lot of different industries to diversify their risk. Mid-cap is like a baby blue chip. So you hear about a mid-cap fund. It's a fund that only buys companies in the middle range of capitalization. Usually multi-billion-dollar companies, but not as big as some of the real big ones. Then you have small cap. Small cap stocks usually trade on the NASDAQ exchange. They are still, they're not companies with $1 million. I mean, there still could be billion-dollar companies, but they're on the lower range of capitalization. They're smaller stocks. They're much more volatile. They're much more risky because they are smaller companies that haven't achieved the success of a Johnson & Johnson or an Apple or something like that, and they could fail. Or they could be in need of money all the time, so you get diluted. But sometimes small caps outperform blue chips. And sometimes they underperform. Next is a penny stock. Now, a penny stock, it's a misnomer. We're not talking about stocks that are pennies. I mean, we could be. But the definition of a penny stock is a stock that's $5 and under. And there's some very good stocks that are $5 and under. I trade them all the time. As a matter of fact, my firm specializes in that area, the smaller cap, the really micro cap stocks, up and comings. And this is really where you can make a lot of money if you're right and lose a lot of money if you're wrong. And I've done both. But it's very risky. There's no earnings. They're usually in need of money, which means they have to go to the market repeatedly and raise money and dilute existing shareholders. They're very volatile, and they're really only for speculators. Then you have preferred stock. Well, what's a preferred stock? Everybody's heard the term preferred stock. It's kind of a hybrid between a bond and a stock. Usually comes public at $25 a share. It pays dividends. And that's the reason why people buy preferred stock, because they pay higher dividends usually than common stock. And the word preferred means if the company goes bankrupt, the preferred stockholders get paid first. Now, you're giving up some upside potential by having a preferred stock, and they're not immune to the downside. But there's a lot of investors that like preferred stock. They're not as popular as they used to be earlier in my career, but they're still out there. Then you have international stocks. So if we're talking about a mutual fund, an international stock fund, that means it's stocks from all around the world. Could be the United States too, but it also includes companies in Europe, in Asia, in South America, what have you. And that's a way of diversifying out of your country. Instead of having all your eggs in one basket in one country's market, you have your money in international markets. Then you have sector funds. These are funds that only invest in certain companies in certain industries, like a technology fund, a pharmaceutical fund, an energy fund, a gold fund. But the safest way to invest in the stock market is through mutual funds. Now, I started my career working for a mutual fund company, and that's what we did. We sold mutual funds. And what are mutual funds? They're diversified large pools of money. And depending on the objective of the fund, they'll invest in certain types of investments. It could be bonds, it could be stocks, it could be treasuries, it could be municipal bonds, it could be large cap, small cap. There's actually tens of thousands of funds out there with all different objectives. International, global. So what you do is you go to a mutual fund company, you can buy it through a brokerage account, or you can buy it directly at a mutual fund company, but you're limited to their funds. So if you go to Fidelity Mutual Funds, you're limited to the Fidelity family of funds, which is quite extensive. I mean, Fidelity has a fund for almost anything. Or you can go to Vanguard, buy any of their mutual funds, or T. Rowe Price. It goes on and on and on, American funds. Now, there's two types of funds out there. There's no-load funds and there's load funds. What's the difference? No-load funds have no commission to buy or sell. A load fund has a commission when you buy it. No commission when you sell it. And usually brokers sell load funds. That's how they get compensated, financial advisors. And when you buy a load fund, it could be as much as, say, 5%. Used to be much higher when I was starting in the business, but say 5%. So if the net asset value is the value per share. How do you figure that out? Well, every day the mutual fund at the end of the day figures out the value of all the securities in the fund, and they divide that by the outstanding shares in the fund, and they come up with a net asset value. And that net asset value goes up or down every day based on what the market did. So if the net asset value is $10 and you're in a loaded fund that has the 5% load, you're going to pay $10.50, even though it's worth $10. So if you try to sell it the next day, you're going to get 10, you're going to lose the 5%. And that money goes to the broker, it's split the brokerage firm, it splits with the broker. That's how they make money. That's a commission-based broker. But if you buy a no-load fund, there's no price, no load to buy it, no load to sell it, and no advice. So you're doing it on your own. So if you're a pretty astute investor, you wouldn't want to use loaded funds, especially if you're not having an advisor, because why would you want to pay a commission when you're not getting any advice for it, and you can go to a no-load company like Vanguard or Fidelity and pay nothing? Now, there's two different ways you deal with financial advisors when it comes to the market. Either fee-based or commission-based. The commission-based is the loaded situation that I talked to you about. A fee-based advisor, you're going to have no load funds, but you're going to pay an annual management fee to the advisor. Now, what's better? Now, I've been both in my life. I've been a commission-based stock person, and I've been a fee-based. The beginning of my career I was commission. For the last 15, 20 years, I've been fee-based. What's the difference and what's the advantages of either? Well, the problem with the commission area is conflict of interest. How do I know that this advisor is not putting me into something because they're going to get a big commission versus something else? Case in point is annuities, right? Annuities pay multiples of the mutual funds do. So many advisors, will try to sell only annuities because their compensation is greater. They're not necessarily working for you, they're working for themselves, and that's a problem. Another problem is your portfolio is static. So they'll come to you and they'll say, we have 4 or 5 good mutual funds for you. They buy them for you, they make a commission, and then you're dead to them. They're not making any money off you. And they can't turn your money over again. So you're not going to hear from that person unless there's a way for them to turn over your money and make money on it. They're off looking for their next commission. So you're never going to get the phone call, hey, Joe, I don't like the way the market looks right now, the economy. We need to lower the risk, and that never happens in a commission-based relationship. I shouldn't say never, but rarely. And the problem, too, is that you're paying a commission to the broker, and in a loaded fund, you're paying a very high management fee within the fund itself. You don't see it, but it comes out of the return. Whereas a loaded fund may charge 1.5% to 2% in management fees to run it, a no-load fund may charge 0.3%. So in a management fee scenario, you're dealing with a person who has no conflict of interest because they're not making commissions. They're making the same fee no matter what they recommend for you. And your account is managed usually. When you're paying a fee to an advisor, your account's managed, meaning that your investments are adjusted automatically based on market conditions. And that's what you want. You want to know that somebody's watching your account every day and is going to take action to make sure that you're in the right place at the right time. And you're paying the advisor, you're not paying the fund. Since the advisor is using no-load funds, which have lower management fees, you're transferring that management fee to the advisor versus the mutual fund itself. And now you have that personal relationship with the advisor, and the advisor is working in a managed way. At AFM Investments, I say we manage money, we don't sell investments. Because if we sell investments, we'd get a commission. We don't sell investments. We manage money using investment vehicles that are commission-free. So that's stocks. That's the stock market. The exchanges are places where you could exchange stock. There's always buyers and sellers, and a lot of things influence the price of the stock. But you're never married to one. You could buy or sell anytime you want. Exchanges are liquid, most of them. So if a stock goes up and you want to take a profit, you sell it. Stock goes down, you want to buy it, you buy it. Some people are traders, speculators. You've heard the term day trader. That's what I am. I'm a speculator in the market. I don't invest. I'm a speculator. So I'm looking, I'm doing my research, my partner's doing his research. We're looking for stocks that we could buy today, and if we could sell them this afternoon, that'd be great. But if we sell it 2 months from now or 3 months from now, that's fine too, as long as we get the rate of return we're looking for. And it's speculation. It's risky. The markets go against you at times. But you can make multiples of your money if you're speculating in the right stocks with the right broker, and we've been very successful lately. But we've had periods where we weren't. But that's speculation. That's day trading. That's what these young people are doing with their Robinhood accounts, because Reddit, they're saying, okay, we're all going to buy this stock at once and we're going to push it up and squeeze the shorts. But meanwhile, those companies aren't worth the prices they go to, and ultimately they come down to earth, and the last ones that get in get hurt. The next area is investors. Investors are people who will buy shares and hold it long term. I know people who have held the public service gas and electric stock for 50 years. It's a long-term dividend-producing investment. New Jersey Resources, Con Ed, Microsoft, IBM. They're not traders. They're not looking at what the market's doing at any given time. They're not looking under the cover of the earnings of the company and all that kind of stuff. They're just owning it. And historically, over the long term, that's been a good strategy with blue chip stocks. The market in general, look, if the market's going up, chances are most blue chips are going up too. Some more or less than the market in general, but a rising tide floats all boats. Just as a falling tide lowers all boats. Not all of them. But that's the difference between a bear market and a bull market. A bull market is when stocks are going up. And we've been in a bull market for a long time. Since the 2008 crash, the Fed's been printing money like crazy, injecting it into the market, and we had a bull market, a historic one. That's pushed stocks to valuations that are just as risky as can be, and as overvalued as we've seen since 1929. But a bear market or a crash, I mean, there's no liquidity. Everybody wants to sell. And if you have more selling than buying, prices go down. And that's what moves stocks. A lot of people say, what makes stock go up or down? Demand and supply. It's that simple. If a lot of people aren't selling, most people aren't selling, and people are trying to buy, they're bidding up the price. Whether it's the same of any market, whether it's real estate, gold, anything. Right now in real estate, there's very little inventory, so you got to pay up to get it. Same is true of the stock market. If there's more buyers than sellers, the price goes up. More sellers than buyers, the price goes down. So that's the stock market. It's been all the rage. We got a lot of young people getting involved in it now. It's a dangerous place at times, especially with individual stocks. But over time, the stock market has outperformed other assets, and most likely will, given past history, continue to do so in the future. Let's take a break. 732-505-1160 is the call-in number. My name is Lou Scatigna. You're listening to The Financial Physician. Don't go away.